What will you do when your money works for you? Welcome to the Tech Girl Financial Podcast with your hosts, Victor and Kim Gaxiola. From the home office in California, here is Victor and Kim.
So, Kim, we have an exciting podcast today. We're on a roll here with these great speakers and guests that are joining us on the podcast. But today we're going to talk about a subject that actually gets a whole lot of press, and that's talking about ESG investing.
That's right. It's so exciting to be digging into the details of investment strategies, my favorite topic.
Well, we've covered dividend-paying stocks and investing in infrastructure. And so today we've got a very special guest. It's Margaret Leung, who's joining us from Nuveen, who's going to talk to us a little bit about ESG investing, their selection process, and why it's getting so much press.
Yes, so she will fill you in on what ESG stands for. But if you have heard about social impact investing, this is what you want to listen to.
So without further ado, here's our conversation with Margaret.
Welcome, Margaret. We are so excited to have you on our podcast today. Before we get started, why don't you tell us a little bit about yourself?
Sure. Thanks, Kim. It is so exciting to be here, even though it's virtual. The way that technology has allowed us to connect over the past two, going into our third year, is really awesome. And over that same time period, the growth in this space of ESG has been equally as bountiful, abundant, and growing. So I work for a firm called Nuveen. My role there is to work with financial advisors and investors to help guide them through specifically ETFs, exchange traded funds. But the biggest topic that we typically talk about is ESG. And we can get into what that means, but just big picture, it's environmental, social, and governance. It's corporate governance.
Yes, thank you for spelling that out because I'm sure not everybody in our world, especially our clients, don't know all those acronyms that we're so famous for having. So environmental, social, and governance. What does that exactly mean?
So it is a term that's been coined in recent history. Gosh, we've had these strategies out for 5 years. I don't know when it first came out, ESG, but it's a derivative of responsible investing, or once upon a time was called socially responsible or impact. We get a lot of alphabet soup that can describe it, but essentially it is criteria that we can look at a company and see how are they doing from an environmental impact. That's really resource management. The S stands for social responsibility. That's your health and safety of your employees. And the G is standing for governance. This is well-run companies. So ESG investing is a term, like I've said, it's come out of responsible investing. But what's really unique about this is that it's inclusionary. We can look at a best-in-class approach for companies that are operating versus their peers in ways that aren't necessarily found on balance sheets. That could have a really big impact to the results of their company. So actually, one of the most interesting statistics that I've come across in my work with ESG is considering that over 84% of the value of the S&P 500, which people refer to as the market, the majority of the value is in intangible assets. So it's not on products that are sitting on a truck and getting delivered into a store. It's nothing that you're going to see on a traditional balance sheet, but it's these intangibles that can really still have an effect on whether their stock price goes up or down. So it's things like brand reputation, brand recognition. How are you treating your employees during COVID? So your employee satisfaction. One of the really interesting things that we've seen through COVID is this great resignation. People making decisions that they're ready to leave the workforce or looking to make a change. You and I are here interacting virtually. We actually have never actually shaken hands in person, but I could be doing this sitting from the company that I'm with now, and of course I'm staying here forever. Or if a competitor comes and says, hey, we'll offer you double, can you do the podcast like with a different login? People are considering that. And so COVID and ESG has actually brought up some really interesting and compelling arguments for considering this type of assessment when looking at companies.
That's so interesting. So correct me if I'm wrong, but first of all, your statistic that said, what was it, 84% of the S&P 500 is intangible assets?
Right.
That to me is amazing that we're not looking at products flying off the shelves when we think about, well, companies and what they do. It's a lot of service oriented is what you're saying, right?
Yeah, exactly. I mean, I think like when we look at how do you measure a brand's reputation on a balance sheet? You can't, but you think about all these dynamics that we have for information gathering right now, the hashtag, for example, on social media, these terms that can be trending. This is not a referral or a suggestion for an investment, but I'm just one that I remember happening a few years ago is hashtag delete Uber. And I don't remember what it was about, but it trended. So it's like, okay, we're not going to use Uber right now. We're going to use Lyft instead. Hashtag B2, hashtag whatever. You could start a social movement now, and what actually is helping companies make decisions and react. And this is all related to ESG. And again, this intangible thing about your reputation, your recognition, and the way that we're consuming information these days.
Mm-hmm. So, Margaret, given the fact that these intangibles, as you're saying, may be difficult to measure, I'm just curious from your perspective, who's getting it right? And this is not necessarily an endorsement of any one company. I'm just kind of curious, in the world that you see, what companies are, hitting it out of the park when it comes to ESG?
That's a really good question. And it's one of the challenges right now as this frontier measuring systems come into place. It's not just competition, but different approaches. We use a variety of information sources when looking at ESG and responsible investing as a firm. I would say the two forefront data providers out there are MSCI and Sustainalytics. I think those two are the ones that have a lot of information that's out there. They have a lot of specialists and analysts who are looking at these key performance indicators that they've deemed worthy of being measured from an ESG perspective. Additionally, it's what do you do with those subscriptions of information when you get them? Because a lot of it can be public information, or even these scores from these third parties, MSCI and Sustainalytics, could be Googled and found. The next thing that an investor or a financial advisor might want to look at is who is the company that's taking this information and synthesizing it into an actual investment and applying it. So when you look at that parent company, so my parent company would be Nuveen or TIAA, you're going to want to look at what practices they have in place as far as proxy voting. Is it going to be aligned with the type of investing that you are wanting to engage in, which brings me to their next word, engagement. Are they engaging with corporations and the community to encourage them to operate in an ESG friendly way? So there's a couple different levels there, but those are some things for consideration.
So again, to bring this back to something that our clients can relate to, in these analytics companies, basically MSCI and Sustainalytics, what they're trying to do is see how good of a company really is when it comes to their environmental procedures and their social impact and their governance.
That's exactly right. So you can think of it as researchers. So not only are they looking at the material public information that's out there that gets released with annual reports, which a publicly traded company is required to produce, but they're also looking outside of that. And that brings us back to the intangibles. They're looking at newspapers in the community or in the local language, if it's international, somewhere outside of the US, interviewing employees, getting a bigger picture. And I don't know the statistic off the top of my head, but when I spoke to MSCI about what they're doing and how they're doing their research, the majority was actually coming outside of material public information. It was good old-fashioned research that they were doing that was going to get plugged into these key performance indicators, KPI, that we're trying to take things that are intangible and then make them measurable.
Yeah, and Margaret, we've seen definitely an increase in the amount of copy or stories that are being written about ESG and the actual conversations around it. And I'm just curious from your take, what would you attribute to its growth from going from something that people really weren't talking about to something that people are talking about all the time?
That's a really good question. So ESG 5 or 6 years ago, when we first had it as an investable option, was a new term. And if I'm going to be totally honest, the reason why I gravitated towards it myself, picking it up and researching it and really understanding it, I'm born and raised in California, moved to Chicago after the financial crisis, and I was a little bit maybe of a unicorn in the Midwest. People wanted to know, do you eat meat? Do you surf? Do you like avocados? And all of these things. And some of it was kind of funny because it was like, this is just so stereotypical. But on the other hand, and something I would reflect on while I was doing all this ESG research and people asking me, is this a fad? Is that where I grew up in Southern California, we had an electric charging station at our public library for cars in the 90s. Before probably anyone had one, we were already trying to accommodate this disruptive, forward-thinking technology. And so it's interesting, like whether you grew up on a coast or a Midwest might be seeing ESG as a fad, but we're seeing more and more current events that people are just being naturally drawn to being interested in this type of investing, whether or not it has a name or not. And so I can talk historically what we see over time. So even though history isn't exactly repeating itself, it definitely rhymes. And so you could rewind to the late 60s, early 70s, and this actually is kind of related to the colleges that we all went to. What's happening then? That's when my dad, who actually started at Cal Berkeley, and had to transfer down to UCLA because there were so many riots and protests at the student level for getting out of Vietnam. So we have this political uncertainty, what could be seen as a social injustice that was early 70s. You move into divesting from South Africa, the Exxon Valdez oil spill, so on and so forth. And all of a sudden you get up to 2020 and we have George Floyd. And so I'm just talking a lot here, but it's really interesting to see the evolution over time that this is not new. People were asking to invest like this for about 50 years now, but it's just becoming more and more specific.
That's so fascinating. So, and I do remember, 5 to 10 years ago, people slowly starting to talk about it. But when you looked at performance, you really had to make a choice. Did you want to perform with the market, or did you want to do good and give up some performance? Is that still the case?
That happened, and that's not the case, and I'll explain why. So you're taking me somewhere really interesting, and one of the reasons why we have outperformance is because we have more information now. And I don't know if I can say outperformance on this, but where you're seeing that you're not going to sacrifice performance in order to integrate ESG because of these analytics companies like Sustainalytics and MSCI. We at Nuveen just feel like this is more information we can make better decisions with. So if you look at where this originated back in the early 90s, these could have been maybe faith-based funds or very exclusionary funds that didn't really have an investment rationale behind them. It's just like, I feel like weapons are bad, and I feel like alcohol and tobacco is bad, but there wasn't really an investment rationale. Now we can tie these things together and actually say, okay, what's the root of this, and why would it not be good for a portfolio? Well, some of these what we call controversial business involvements, their products kill people. Okay, well, if you have a catastrophic event where a bunch of people die, a mass shooting, or perhaps you're getting sued because tobacco is being tied to a million types of cancers, it's bad for your share price. So we're able to connect the dots. We're gathering more information. We have more information that's being reported that we can actually analyze, which is really helping actually identify the best in class and leaving the laggards out of our portfolios.
So it goes back to technology and data analytics. We have more information to generate this information, which in investing at large, we have so much information, and there's a lot of details that can make a stock get into trouble. So now that all that information is so easy to access, you really do have to do good to have good performance, is pretty much what I'm hearing from you.
That's definitely part of it. I think that in this age where, again, there is all this information, people like to do their own research, that it is important that there is the shareholders and stakeholders have a bigger voice and are powerful with the different outlets that they have, again, tied to technology, whether it's social media, voting with their dollars, and consumerism. I think we're definitely in a different place where, again, the consumer, the shareholder, the stakeholder, all their opinions matter.
Mm-hmm. And it sounds from your previous comments too that and maybe traditionally it was a little bit easier for people to articulate the things that they didn't want in their portfolio versus the things that they did want. Don't want a sin stock, don't want a stock that deals with gambling, or, as you said, tobacco or oil and things that are affecting the environment. So I'm curious about Nuveen and your specific selection process. What do you look for then in a company that might make your list, or at least the ones that you would support?
Oh, sure. So the way that we look at a methodology is we'll take an entire universe of companies. Like, let's just take a look at the large cap growth universe, or we could look at small cap or mid or even international markets. But we'll start with some sort of universal starting point. And what's really interesting about ESG scores is that they're just a score. It's not an achievement. It's not an accolade. You don't earn an ESG score. You just get one. It's like being a student. You could be A or you could be F. And so what's important for us is to draw the line, like, where is acceptable? Like, this is like, again, college admissions, like, who's going to be able to even be eligible for our universe? So we are looking at sector by sector, industry by sub-industry, and we're only comparing companies versus their peers for this ESG criteria scores, because it's really interesting. Like, a materials company is not going to have the same inherent risks related to ESG as a tech company. Tech company, we want to make sure that they're not spying on us, that their corporate governance is strong, that they're not going to have a huge data breach and let all of our information all over the web, something like that. That would be bad for a technology company. Not as big as a deal for a materials company, someone that's making, like microchips, because we all need those in our phone. If it's a microchip company, we're going to want to know, what is your supply chain? Who is your labor? How are you sourcing the materials for your chips? What are sort of toxic waste emissions could be a result of your processing of your product? So ESG scores are the very first thing that we look at, and they're very specific to the type of industry that the company is in. The next thing that we look at is controversial business involvements. And we call it that because it's, in our opinion, a little bit more not specific, but accurate, I guess, instead of calling it a sin stock or a vice. It's truly just controversial. One of the topics that we have in there, or business revenues, is nuclear power. Some people say this is extraordinarily clean. Look at France. They're doing a great job with it. We're just saying it's controversial. If there were a mistake or some sort of event like a Fukushima or a Chernobyl, and just to be very blunt, you held that share of that company, it's going to be bad for your share price. So 1 is ESG scores, 2 is controversies, and the third is carbon intensity. This is really aligned with investor perception of what ESG is. ESG is not necessarily green and it's not low carbon, but because this is something that we see as a business risk, having exposure to consumption of a commodity that's volatile, and there could be legislative risk around your exposure to it, we take that out too. And so everything that we're doing for this methodology is based in returns, risk management, volatility, and things like that. It's not just because we want to feel good about it. There's a lot of thought behind what's going to add to performance or detract from the downside.
That's interesting. So now we know a little bit more about the category. What would you say in terms of investor interest? It does seem like there's more and more money going into that category of funds. And so my thought process, because I love to look at technical analysis, and for those that don't understand that as much, it's just money flow and looking really at what are those companies that have higher momentum, and that's all based on higher demand and investing in those stocks. So I sometimes think, well, what's going on with ESG now? Is it truly that this is a trend that's going to stay with us forever? Or is it something that, like the 70s was here and there? Will these funds become overvalued just because there's so much money that is being invested in right now because it's a trend?
I think that is a question and a concern that many people have. But if you zoom out a little bit, what you'll see, and this goes back to ESG not being an achievement or a designation, it's just looking at companies versus their peers at any one given moment of time of how are they doing. So yes, maybe there could be some sort of artificial flow inflation that's temporary. If you look at 2020's ESG flows, it's twice as much as 2019. We've got this what sometimes is referred to as a hockey stick chart, that it kind of took a few years and all of a sudden it takes off. At the end of the day, ESG might just go away as a title, because what we're finding is that when we're looking at the intangibles of a company, actually measuring them and applying it, we're getting results. So there's a good chance that this just might be called investing in the next few years. We're already starting to see it and getting feedback from our consultants who work with financial advisors that it's getting bigger than just ESG. It's dissecting it and saying, this is risk management, this is resource management, this is keeping employees with business continuity, this is keeping CEOs off the cover of the New York Times for the wrong reasons. So it's really just good companies where we're looking at parts of them that just haven't been measured before.
Mm-hmm. So it sounds to me that it could be a measure that that doesn't even need to exist just because it becomes table stakes from the standpoint of an expectation that companies are going to be a little bit more responsible in these areas. Because we're already seeing it, I think, when it comes to employees having a choice of where to work, that they're asking questions about, the company's governance and what they're doing as far as the environment, what they're doing as far as social programs. They want to work for organizations that they feel are being responsible in that respect. And so I'm curious, have you seen companies be more proactive in trying to address, some of these intangibles to increase either their ESG score or at least the perception in the public?
Oh, absolutely. I think anyone who's employed right now, even if you just kind of got general feedback from the population, it's like, oh, my company has this resource group. We have flexibility. We're adding pronouns to our LinkedIn, to our signatures. We are, flexible work week to accommodate working parents, unlimited vacation. Like, I think that it's reflective of just every day. And where you see it actually documented is something that we call corporate engagement. And so this one's not so intangible because it's extraordinarily measurable and optically you can tell. This was a few years ago, one of the projects that Nuveen worked on, which was to write a letter to companies in the US and Japan where they had very low gender diversity on the board. And I mean, I'll just fill people in why gender diversity might be important. If everyone has the same background, the same schooling, the same socioeconomic status growing up, if you're faced with a problem, you're probably going to say, we saw this before and this is how we solved it. We saw it before, this is how we solved it. And you're going to have 12 people give the same response or the same idea of how to solve. If you have people saying, well, we grew up in, the other hemisphere, or this is how this was addressed when we had limited resources or different resources than you had when you solved it, you get a better pool of ideas to solve problems. And so board diversity, whether it's gender or socioeconomic status or just geographic, can be important. Anyway, back to this engagement, we sent over 700 letters to the US and Japanese companies. We had over a 40% response rate to it. And by doing things like that, you start working at the company levels where you do start seeing change, whether it's coming from corporate engagement or end investors.
That's exciting to hear all the change that's happening because of companies that are looking to engage in that type of investing.
Yeah, and I think that being in the heart of Silicon Valley, where there's a lot of competition for engineering talent or talent that works in the tech space, that is a big criteria for a lot of the employees in making their selection as to which companies they work for, is that they're looking for that, the responsibility of the organization and whether they are contributing both to their local communities, to the global community, especially for a lot of these large multinationals.
Do you feel like there's any risks involved with this type of investment? I always like to say to clients, when we provide these different types of investment strategies, there's the opportunities that we can see, but what are the risks in searching in this way for investments?
Sure. I don't know if there's like a risk on the downside, because I mean, the worst case scenario, you don't integrate responsible investing or ESG and you have status quo. So that's going to be the worst case scenario for someone. The risk, I guess, and another way to put it is what you might want to be looking for is a term that investors are calling greenwashing. And it's interesting. I have a friend, she's a high school teacher, and I asked her what it meant to her. And I think most people, have an opinion. Greenwashing, it's a company saying they're doing something regarding the environment or social responsibility or their corporate governance just to say it is. Like it's really all about the talk, not a lot of action. And the example that this friend gave me was she had bought a sponge, and the sponge said it was 100% recyclable. And she thought that was really neat. And then when she looked into actually how you recycled it and that you had to have a special package and you had to ship it away somewhere to have it maybe be recycled at the end of the day, and thinking about the carbon intensity that it would take to get there, she gave that as her example of real life. Like, to me, that's greenwashing. So you want to see, like, again, worst case scenario, it's status quo and you throw your sponge away, but really it's just that you're not going to be getting what you think you're getting. So investors like to peel back and see, do you put your money where your mouth is? How are you voting with your proxy ownership of these companies? What are you doing to engage? Those are ways that you can do a little of your own research on what to be looking for to avoid greenwashing.
Yeah, and I think that that's an important point there, that it does require a little bit of research and a understanding of the bigger picture. I only recently was on a webinar and I was listening in, and they were talking about how, as encouraging as it is that people are moving towards electric vehicles and battery powered vehicles, and the fact that it's good for the environment, that there's that other dichotomy, which basically says, yes, but to do that, you need to mine copper. And that does take oil and coal resources in order to mine the copper to build the electronic cars. So it's that, that kind of that dichotomy that exists, this, you're doing good on one, but then that does mean that you still have to do things that people might not see as being, as environmentally friendly.
I didn't know it was called greenwashing. So that's a great term that I've just learned today. Thank you very much for that. And I would say, and I have heard conversations in circles here in Silicon Valley where people are really interested in doing the right thing, but that if we can say that there is this greenwashing that happens, and sometimes you hire somebody based on what you think is diversity, and then you find out down the road that that wasn't the best choice. So we know that corporations are familiar with all these great buzz terms. They want to look good for PR, for shareholders, for everyone, stakeholders involved. But how do we know under the surface that they're actually doing the right thing? Because sometimes that could just be what people like to call virtue signaling.
Yeah, that's something for a consumer to look into. There are some global standards actually that a company can be aligned with. So for us, it's the UN Principles of Responsible Investing. So that's just determined by the UN. That's a global organization, obviously. B Corps, this is something that's come up. So for public companies to be achieving at certain levels regarding ESG criteria. But there is, a give and a take for everything. This is not going to just be a zero-sum game of perfection that we could say, yes, if you have an electric vehicle, this is the solution to carbon intensity, because we know that there are costs of mining for batteries, and what is where does the old battery go, or how much energy does it take to create this? Where are these things being created? So I think that takes us to the thought of how do you do this without being perfect? And one of our approaches that we do here is a best-in-class approach. So it's not about, and we kind of talked about this already, it's not about the exclusionary nature, like cutting out and punishing the bad actors, but instead rewarding the companies that are doing the best that they can based on their ESG criteria that they're doing, that's either revealed in their annual reports or research that these companies who are designed to gather that information do. So I think that's another thing to keep in mind, that it's not perfect, and we can't let kind of this inability to have perfection stop, I think, the progress that putting dollars towards ESG, the benefits of that.
I would say that the big takeaway in all this is that it's encouraging to see that there at least is this additional criteria by which is driving people's decisions. And the fact is that maybe traditionally some of these ESG funds and such or companies were not really performing, to the point where you'd feel confident in investing in, especially if you're investing for performance. But I don't want to lose the sight of the fact that this is good. The overall is good, of companies being more responsible, of diversifying their boards, of finding things that are going to make people feel better about how they invest their dollars, because that's really what it is. It's them voting with their dollars. And if it helps with competition, and this being an additional criteria for competition, I think it only raises the bar for everybody.
It does raise the bar for everybody. And I think if I could predict the way it would look in 20 years from now, it isn't its own category of ESG, but it's just what every manager has to do in order to play the risk management game.
I agree 100%. That's what we're seeing. It's risk management. It's more information to make better decisions with. And I think definitely 20 years down the road, we won't be talking ESG. It's just going to be like this is investing. These are criteria we've got to consider to win.
Well, before we let you go, and we want to thank you so much for your time today, but do you have any final thoughts, or is there anything exciting that you're going to be working on this year?
Final thoughts. This is a big one. This is just outside of me. This is just in the news that I'm reading. Last fall, there was a big movement by Harvard for divesting from fossil fuels. And it's really interesting, this concept of, do you divest or do you stay invested so you can engage with these types of companies? And so that's really the hot topic that I've seen bubbling up lately. Do you use your voting power and make a change, or do you ghost them?
That is a whole different podcast we could have. I love that. It's very interesting. How do you want to take part in that whole area? And I tell you, it's funny when you talk about that, because I strongly dislike how our society plays this game. It has to be one or the other. And so the easiest example is, in order to have a better environment, we all have to go electric. I actually think it's better off for all of us to diversify and not have all of our eggs in one basket, and have some people driving electric and have some people driving gas consuming cars. And so I wish we would get away from this whole idea that it's all in or it's nothing, which may be just a conversation for another day.
I'll come back. That sounds, I agree. Maybe don't have me back, because I think that I agree with that. We would have a one-sided conversation.
Well, we want to thank you again, Margaret, for joining us on the podcast today and sharing your insights. And we certainly would love to get you back on the program sometime down the future to continue this conversation.
Yes. So thank you very much.
So another fascinating conversation with an expert in space. This was so good.
That really was a great conversation. And for all of our clients that are out there listening, if this is something that you really want to talk to us about and incorporate in your portfolio, of course, a lot of portfolio managers are already incorporating it. Mm-hmm. But if you want to be more focused and have some funds that are just very laser targeted in this area, we do have some recommendations for you. So always good to talk to us about that.
Yeah, because we're all about options, really. When you think about the last couple of podcasts that we've been recording and talking about investing in infrastructure and dividend-paying stocks, and now ESG investing, it really is, look, you've got to vote on where you want to put your investment dollar, and it's our job to find the right fit for you. And so, as Kim has said, if this is an area you'd like for us to explore and work with you, and is provided that it's a good fit for your portfolio, we'd love to talk and explore about what companies would make the most sense.
That's right. It's but the lines are getting blurry, right? Yeah. And it's good to know now that in the past, it was something that people did feel you had to give up performance to have. And now it looks like it's just a part of risk management, so you don't have a stock blow up in your face.
Mm-hmm. And I think what's good, or the good news, and this is how we kind of ended our conversation with her, is that this will become probably table stakes for most organizations that want to be competitive, regardless of the industry that you're in order to showcase to the world and showcase to the people who are investing that you are taking these measured steps to focus on these key areas that really fit to people's values. And so whereas before, I think a lot of people who were more values investing were more inclined to say the things that they wouldn't want in their portfolio. Now it's more inclusion. It's like, what do I want in my portfolio?
Right. And to take it back to why this is so important, or how this has become table stakes, is to go back to one of our other favorite subjects, which is technology. And that we now have the technology to screen for this kind of data, and it allows investment managers to make smarter choices.
So we want to again thank Margaret for joining us on the podcast today, and we hope to continue bringing great guests to the show. So as always, we encourage you that if there's a subject you'd like us to discuss and explore, or a person you think we should bring on the show, feel free to reach out to me at victor@techgrowfinancial.com. You can also find us across all the social networks, Instagram, LinkedIn, Facebook, Twitter, YouTube. We're all over the place. So feel free to find us. And if you have a question, I encourage you to go to our website, go to the podcast page, and there at the very bottom, you can ask a question.
So that covers it.
So thank you again for joining us on the program today. And we'll see you next time on the Tech Girl Financial podcast, where, as we always like to say,
what would you do
when your money works for you? Thanks for listening. Take care.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. Tech Girl Financial and Cambridge Investment Research, Inc. are not affiliated companies. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.